37.6 million ounces disappeared in 47 days from the COMEX vaults, the largest drain since 1980. And you know what else happened in 1980? Silver hit $49 an ounce. Then the entire futures market nearly collapsed. It took a rule change, margin requirements skyrocketing, forced liquidation, chaos. And I keep asking myself the same question I've asked for months now. If silver doesn't matter like so many experts claim, why would the silver inventory collapse by 57% in just 14 months? Why would lease rates spike to 39% in October? Why would the metal trading in backwardation spot price higher than futures, something that almost never happens? These aren't random events. These are signals of something massive unfolding right now in December 2025, in real time. And what I've discovered is this. The COMEX vault drain follows a four-stage pattern, a pattern that's been hiding in plain sight through every commodity crisis in history. And right now, we're in stage 3. The squeeze stage, the moment when inventory collapses, physical demand panics, and the system realizes something fundamental has broken. Let me show you what stage 3 looks like, why it's different from every previous shortage, and why the math says what comes next is inevitable. Before we go through the pattern, you need to understand what the COMEX actually is. The COMEX is the commodity exchange in New York. It's where silver futures trade. It's where the price of silver gets discovered. And here's what most people don't understand. The COMEX isn't just a market, it's the market. More silver contracts trade on the COMEX every single day than exist in physical form in the entire exchange vault. Think about that. The world trades imaginary silver, paper promises, digital contracts at a scale 100 times larger than the metal that's supposed to back those promises. This creates a system where physical silver is scarce, but paper silver is abundant. This creates a system where as long as physical supply is sufficient, the paper market functions. But when physical supply gets tight, when people actually demand delivery of real metal, the entire structure becomes vulnerable. And right now, the structure is showing cracks. Serious cracks? The cracks started appearing a few years ago, but 2024 is when they became impossible to ignore. Let me walk you through the timeline because the timeline is critical to understanding what comes next. In March 2020, right before the pandemic, the COMEX had 346 million ounces of registered silver. Registered is the critical category. That's the metal available for immediate delivery against futures contracts. That's the real inventory. By December 2023, that number had fallen to 82 million ounces, 76% decline in just 3 years. But that was the warning. The real story is what happened next. In October 2024, COMEX registered inventory stood at 100 million ounces. Then something shifted, something accelerated. Between October 1st and November 15th, 37.6 million ounces simply vanished. In 47 days. 1 million ounces per day in some cases. 47 days and the vault went from handling deliveries to barely functioning. By December 2025, right now, the inventory sits at 43 million ounces. That's only 18 days of global silver consumption. 18 days. Think about what that means. If the world stops producing silver tomorrow, if no new ounces enter the market, we have 18 days before the COMEX vault is empty. Not 18 months, not 18 years. 18 days. And the rate of decline accelerated as prices rose. This is the critical pattern nobody wants to admit. As silver got more expensive, demand increased, not because people wanted it more, because they knew it was running out. And as demand increased, the vaults drained faster. This is the feedback loop that defines stage 3. Prices rise because inventory is falling. Inventory falls faster because prices rise and incentivize withdrawal. It feeds on itself. So where did all this silver go? That's the question everyone asks, and the answer is both simple and complex. Some went to industrial users, solar manufacturers, electric vehicle makers, electronics companies. All of them started hoarding in early 2024 when the shortage signals became impossible to ignore. Some went to investment funds. Silver ETFs had inflows of 95 million ounces in the first half of 2025 alone. Not selling, buying, massive institutional money flowing into silver, and some went to private vaults, to people and institutions who want physical metal in their possession outside of the banking system, outside of the exchange. But here's what's crucial to understand. Before I continue, you need to know where this leaves us. 346 million ounces in March 2020. 43 million ounces in December 2025. That's a 303 million ounce decline in 5 years and 9 months. Over 50 million ounces per year disappearing from the exchange, and the pace accelerated in the last 14 months. This is the trajectory of a system running out of a critical resource, not gradually, urgently. Mining cannot replace this. Let me show you why. 70% of global silver production comes as a byproduct of lead, zinc, copper, and gold mining. 70%. This means silver is not a primary product, it's secondary. When a mining company pulls ore out of the ground, they're trying to extract copper or zinc or lead. The silver comes with it. But here's the constraint that changes everything. If the price of copper crashes, miners stop mining, even if the price of silver is high. Why? Because the economics don't work. The cost of mining, the cost of processing, the cost of everything involved in pulling that ore out of the ground has to be justified by copper revenue. If copper doesn't justify it, the entire operation closes. And when that happens, silver production stops. Just stops. This is why silver supply is inelastic. You cannot increase it independently. You cannot say, we need more silver, let's mine it faster. It doesn't work that way. The mines are closed or running at reduced capacity, not because there's not enough demand for silver, but because the host metals aren't profitable enough to justify operations. This is a structural constraint that cannot be overcome with capital or innovation. It's geology. It's economics. It's the way the system is designed. In 2015, global silver mining hit a peak of 887 million ounces. That was the maximum the system could produce. Since then, production has been declining or flat. 2024 saw production of 843 million ounces, down from the peak, down from 2015, and projected for 2025? 843 million ounces again, no growth, flat. And meanwhile, demand is growing. This is the most critical number in the entire story. Let me tell you about the demand side, because the demand side is where the real squeeze is happening. In 2024, global demand for silver was 680.5 million ounces, up 4% from the year before, up consistently for 4 consecutive years. Where is this demand coming from? Solar panels, photovoltaic solar panels. 232 million ounces consumed in 2024. That's 34% of all industrial demand. 10 years ago, solar accounted for maybe 60 million ounces annually. 10 years, from 60 million to 232 million. That's a 300% increase in a decade. And the growth rate is accelerating. The International Energy Agency projects that by 2030, solar will require 250 million ounces annually. But that's just solar. That's one use case. Add in electric vehicles. A traditional car uses 25 grams of silver. An electric vehicle uses 45 to 79 grams, nearly triple. EV sales are accelerating globally. Sales of electric vehicles have doubled in the last 3 years, and as EV adoption accelerates, silver demand accelerates with it. Add in data centers. AI data centers require exceptional electrical conductivity. They're choosing silver for precision applications. Data center electricity demand is growing 21 to 33% annually. That's the fastest growing segment in the entire market. Add in electronics, medical devices, catalysts, brazing applications, jewelry, silverware. Total demand exceeds 680 million ounces annually. And production, 843 million ounces. The math is simple. 843 minus 680 is 163 million ounces short every single year. Actually, it's worse than that because I'm using old numbers. The deficit for 2024 was actually 148.9 million ounces, the largest single-year deficit on record. And 2025 is projected to be worse, 207 million ounces short. That means above-ground inventories that took decades to accumulate are being consumed in a matter of years. The COMEX drain is just one visible indicator of a global problem. Inventories everywhere are depleting. The London Bullion Market Association vaults had 35,000 tons in April 2020, 21,000 tons by 2023. The Shanghai Futures Exchange, which tracks physical silver in Asia, hit a minimum of 937 tons in recent months. This is not one exchange draining silver. This is a global phenomenon. Everywhere you look, silver vaults are emptying. And let me be clear about what the deficit means. If production is 843 million ounces and demand is 680 million ounces, you might think the deficit is 163 million ounces. Wrong, that's what the math says. But that assumes all mining production makes it to the market. It doesn't. Some sits in company inventories for processing. Some get stuck in the refining pipeline. Transportation delays mean silver that's mined doesn't immediately reach end users. And more importantly, the deficit calculation assumes we're not drawing down inventory to meet demand. But that's exactly what's happening. We are consuming inventory because production cannot meet demand. So the real deficit is higher. And it's cumulative, 5 years of consecutive deficits. 2021, 50 million ounces short. 2022, 70 million ounces short. 2023, 85 million ounces short. 2024, 148.9 million ounces short. 2025 projected, 207 million ounces short. Cumulative, 661 million ounces. That's 661 million ounces drawn from above-ground inventories in 5 years. Inventory that had accumulated over decades, disappearing in a matter of years. And at this rate, at this pace, the strategic supply that exists outside of production is being consumed. It's not infinite. Nothing is infinite. When you draw down inventory at a rate of 130 million ounces per year, on top of a structural production deficit, on top of production that cannot respond to price signals, you have a problem. You have a systemic problem, a problem that creates stage 3. So what exactly is stage 3? Let me define it clearly because this is crucial. Stage 1 is abundance. Supply exceeds demand. Inventories build. Prices are low. Nobody worries about shortage. Stage 2 is the beginning of pressure. Demand starts exceeding production. Inventories start declining. Prices rise modestly, but people still believe there's plenty. Stage 3 is where we are right now. Demand has clearly exceeded production. Inventories are collapsing. Prices are rising sharply. Physical metal becomes harder to get. Lease rates spike. Backwardation appears. Traders and industrial users begin to panic. They realize the system has changed. They're competing for limited supply. Some will get metal, some won't. This is stage 3, the squeeze. The moment when the market realizes scarcity is real, and once stage 3 begins, the math becomes mechanical. Lease rates tell the story. These are interest rates charged to borrow physical silver. Normally, the lease rate is less than 1%. Sometimes it's 0.1%. It's cheap to borrow silver. Why? Because there's plenty. But in October 2025, the 1-month lease rate spiked to 39%. 39% annualized cost to borrow silver for just 1 month. That's a 6,500% increase from the normal rate. What does that mean? It means traders were so desperate for physical silver, so desperate to cover short positions, so desperate to avoid delivery failures, that they were willing to pay 39% per annum just to borrow metal. This doesn't happen by accident. This happens when the market realizes something is wrong. This happens in stage 3, and the lease rate spike has historical precedent. In 1980, before silver crashed, lease rates spiked. In 2011, before silver rallied, lease rates spiked. Lease rate spikes are the early warning system. They precede major moves. They signal that the physical market is stressed, extremely stressed. And right now, in December 2025, we're at a lease rate spike not seen in 15 years. Backwardation appeared in October. Let me explain what this means because the terminology matters. Normally, futures contracts that expire further out trade at a higher price than contracts expiring soon. Why? Because of storage costs. If you buy December silver, you get it in December. If you buy March silver, you have to pay for storage and insurance between December and March. So March should be more expensive. This is called contango. It's the normal market condition. Contango means there's plenty of supply. The market is comfortable holding inventory forward in time. But backwardation is the opposite. Backwardation is when nearby contracts trade at higher prices than future contracts. It's when people are willing to pay more to get silver today than to get silver in the future. This is insane from a standard finance perspective. Why would you pay more for something today than you would for it tomorrow? You wouldn't. Unless you believe tomorrow might not have enough. Unless you believe supply might not exist tomorrow. Unless you believe the future was uncertain. Backwardation is a physical shortage signal. It's the market screaming that metal is tight. Tight right now. October 2025 saw spot silver trade $2.88 above futures. That's unprecedented. That's a market in distress. And the backwardation lasted into November. The signal persisted. This is stage 3 behavior, and it has historical precedent. In 1980, backwardation appeared before silver spiked. In 2011, backwardation appeared before silver rallied. Backwardation is the market's way of saying supply is about to become a problem, a real problem. J.P. Morgan holds 169 million ounces of silver in COMEX vaults. This has been verified through COMEX warehouse reports. Public data, 169 million ounces. That's 40% of the registered inventory. That's the largest position in the entire exchange. And it's not a recent development. J.P. Morgan has been accumulating since 2011. Analysts estimate their total silver holdings at 675 million ounces. That would represent roughly 45% of the world's above-ground supply in 1,000-ounce bars. This is not an accident. This is not the byproduct of normal banking operations. This is an intentional accumulation, and the timing matters. J.P. Morgan started accumulating when silver was cheap. In 2011, silver was being suppressed by the banking cartel, a term used by researchers who have documented the paper market manipulation. J.P. Morgan bought cheap. For 14 years, J.P. Morgan accumulated quietly, systematically, while analysts debated whether silver had a future. While the market paid no attention, J.P. Morgan was positioned for exactly what's happening right now. Now, here's what most people don't know. In 2020, J.P. Morgan settled charges of spoofing and market manipulation in precious metals markets. They were convicted, not charged, convicted. They paid $920 million. The trading desk head, Michael Nowak, pleaded guilty. Another trader, Greg Smith, was convicted. They manipulated the silver market from 2009 to 2015. They placed fake orders to move prices. They made money from the manipulation, and J.P. Morgan paid the fine, returned the profits, and life went on. No criminal charges, no prison time for the executives. The bank paid a fine that was negligible relative to the profits. And then J.P. Morgan resumed operations in precious metals like nothing happened. And now, in December 2025, with 169 million ounces in COMEX vaults, with silver in backwardation for the first time in 15 years, with lease rates at 39%, the question becomes obvious. Is J.P. Morgan positioned for a breakout? Are they sitting on physical silver, waiting for the day when the paper market fails and the scarcity becomes undeniable? The evidence is circumstantial, but the circumstantial evidence is overwhelming. In late 2024, J.P. Morgan reclassified 13.4 million ounces of silver from registered to eligible. Registered is available for delivery. Eligible is not. This reclassification reduces the available supply by that amount. It tightens the market artificially. The timing was October and November 2024, exactly when lease rates were spiking, exactly when backwardation was appearing. J.P. Morgan reduced available supply at the moment when that reduction would have maximum impact. Coincidence? Maybe. But the pattern suggests something else. The pattern suggests positioning, strategic positioning for what comes next. And what comes next is stage 4, and stage 4 is where things get interesting. In 1980, stage 4 looked like this. Silver spiked to $49.45. The Hunt brothers, who had accumulated 200 million ounces and were demanding physical delivery, nearly broke the entire exchange. COMEX panicked. They changed the rules. Silver Rule 7. No new long positions. Leverage requirements skyrocketed. The Hunt brothers were forced to liquidate. Prices crashed 78% in a single day. March 27, 1980. Silver Thursday. The market was reset. The system was saved. But through force, through rule changes, through changing the rules mid-game. This is what's available to regulators if the squeeze gets too extreme. In 2011, stage 4 looked different. Silver rallied from $32 to $49 in 4 months. The rally was strong but not violent. The COMEX didn't change rules. The market adjusted. Prices climbed, and as prices climbed, demand moderated. Substitute materials started being explored, and the market found equilibrium. Different outcome. Same 4-stage pattern. So which path is the silver market taking in 2025? That's the question. Will stage 4 look like 1980? Rules change. Margin requirements skyrocket. The market crashes 75 to 80% in a short period. Leverage is forced out. The system resets. Or will stage 4 look like 2011? Prices climb steadily. Demand moderates over time. The market adjusts naturally. Equilibrium is found. Or is there a third path? A path where stage 4 is something entirely new, because the situation right now is different from 1980 and 2011 combined. In 1980, it was two billionaires and their leverage. The leverage was concentrated in one position. Kill the position, and the problem goes away. In 2011, it was broad investment demand plus industrial demand. Still manageable. But in 2025, the shortage is structural. It's not leveraged billionaires, it's 5 years of consecutive supply deficits. It's not speculative demand. It's industrial demand that cannot be destroyed. Solar panels need silver. Electric vehicles need silver. Data centers need silver. This demand won't go away because prices rise. Policy mandates that this demand exists. Governments have committed to renewable energy targets. Governments have committed to EV adoption. Governments have mandated that supply chains move in this direction. This isn't market-driven demand that can be killed by price. This is policy-driven demand that must be met regardless of price. This changes everything. This means stage 4 cannot simply be a crash that resets leverage. Because the leverage isn't the problem, the shortage is the problem. And shortages don't disappear because you change margin rules. They persist until supply catches up or demand is destroyed. And demand won't be destroyed. Supply takes 8 to 15 years to increase. So the math says stage 4 is inevitable. The price is inadequate. The price of silver at $59 is not high enough to balance supply and demand. Higher price is required, much higher price. How much higher? That depends on the speed of supply response. If new mining comes online faster than expected, if recycling increases dramatically, if substitution happens, if demand destruction occurs through lower prices killing industrial demand, then maybe $59 is close to equilibrium. Maybe prices don't spike much higher. But if supply response is slow, if mining continues declining, if recycling can't scale, if substitution fails, then prices must continue rising. The math is mechanical. 843 million ounces produced, 680 million ounces consumed, 163 million ounce shortage. The price of silver must rise until one of three things happens. First, production increases, 8 to 15 years minimum. Second, demand decreases, either through price-destroying consumption or through recession-destroying economic activity. Third, above-ground inventory is fully consumed and the system resets. Most likely scenario? All three happen slowly over time, but the transition won't be smooth. It will be volatile. It will overshoot. Prices will spike higher than the long-term equilibrium. This is how markets correct large imbalances. They overshoot. They create a price that's so extreme that it triggers both demand destruction and supply stimulation simultaneously. This is stage 4. This is what comes after. Let me give you the scenarios with probabilities based on historical precedent and current market mechanics. Bull case, 30% probability. Silver rises to $100 to $150 per ounce by 2026 or 2027. Drivers, supply deficit persists. New mining doesn't come online. ETF inflows continue. Geopolitical tensions create safe haven buying. Institutional money continues flowing into physical. The shortage becomes acute enough that price shocks the market. This scenario is supported by industrial demand fundamentals. If solar grows as projected, if EV adoption accelerates as mandated, if data center demand grows as forecasted, the deficit widens further. And a wider deficit requires higher prices to balance. This is the bullish case. Base case, 50% probability. Silver consolidates between $60 and $85 per ounce through 2026 and 2027. High volatility, but no explosive move higher. Drivers, supply and demand gradually rebalance. Recycling increases modestly. New mining comes online by 2026 or 2027. Demand moderates from current levels. Lease rates normalize. The acute phase of the squeeze ends. The market adjusts. This is the most likely outcome. It mirrors what happened in 2011. The shortage created urgency, prices spiked, and then the market adjusted through normal price mechanisms. Bear case, 20% probability. Silver corrects to $40 to $55 per ounce. Drivers, COMEX implements rule changes like Silver Rule 7. Margin requirements skyrocket. Leverage is forced out of the market. Price crashes. Economic slowdown or recession reduces industrial demand. Supply surge from delayed mining projects coming online. Demand destruction from lower prices. This scenario is like 1980. It's possible. It requires a trigger, but it's possible. Most likely? The base case. The market adjusts over time. Prices remain elevated relative to historical norms. COMEX inventory stays critically low at 40 to 60 million ounces. Lease rates remain elevated at 5 to 20%. The acute phase of the squeeze lasts 2 to 3 years. And then gradually, as supply and demand balance, the crisis phase ends. The new normal becomes silver at $60 to $80 per ounce. But let me be clear about something. This assumes smooth adjustment, assumes rational market response, assumes no black swan events. One geopolitical crisis, one major recession, one supply shock, one delivery failure, and all bets are off. The system is fragile. COMEX inventory at 18 days consumption, lease rates at extreme levels, backwardation appearing. These are signals of a system under stress, under duress, a system vulnerable to shocks. What most people are missing, what the financial media refuses to discuss, is that the COMEX drain is not the whole picture. The COMEX vault is visible, it's tracked, it's public, but globally, physical silver is disappearing from vaults everywhere. The London vaults are depleting. The Shanghai vaults are depleting. Private vaults everywhere are receiving massive inflows as investors seek to own physical metal outside of the system. And governments are quietly accumulating. China is hoarding silver. Russia is hoarding silver. India is hoarding silver. The governments that see the shortage coming are securing supply. And this behavior, this accumulation by sovereign nations, this is the signal that Stage 4 is being prepared for. Governments don't accumulate commodities because they're cheap. They accumulate because they're about to become critical. They accumulate because they see supply constraints coming. This is governments positioning themselves exactly the way J.P. Morgan positioned itself, quietly, strategically, in anticipation of what's coming next. And here's what should concern you about Stage 4. If Stage 4 is a violent repricing, if Stage 4 is prices moving from $59 to $100 to $150 rapidly, then industrial users are in trouble. Solar manufacturers need silver. They cannot operate without it. If prices double or triple, if prices reach $100 per ounce, their profit margins get crushed. Their products become unaffordable. They face a choice: produce at lower margins or reduce production. This is demand destruction. This is how the market rebalances. But here's the uncomfortable truth. If solar becomes unaffordable because silver is expensive, solar adoption slows. Renewable energy transition slows. Climate targets are missed. The entire global energy transition depends partly on solar affordability, and solar affordability depends on silver costs remaining manageable. A silver shortage that drives prices to $150 actually harms the energy transition. It harms the very goals that governments say they're committed to. This is the paradox. The shortage of the critical resource needed for the energy transition actually undermines the energy transition, unless mining supply responds faster, unless substitution happens, unless something changes. But the structural constraints suggest nothing changes quickly. Mining cannot ramp fast enough. Substitution is technically impossible for most applications. Demand is policy mandated. So prices must adjust severely, and when they do, the casualties will be real. Industrial users will suffer. Manufacturers will struggle. Supply chains will break. And silver itself, the metal that was supposed to be cheap and abundant, will become precious. Actually precious. Not metaphorically, really precious. The Hunt brothers lost everything trying to corner the silver market in 1980. They accumulated 200 million ounces. They demanded delivery. The market changed the rules and crushed them. They went bankrupt. But here's what's important. The people holding physical silver, not paper, not futures contracts, but physical metal in their possession, they didn't lose anything. When the dust settled and silver had crashed from $49 to $10, people who had bought physical at $6 and held through the chaos, they made enormous returns. They bought physical when it was cheap. They held through volatility. They emerged on the other side wealthy. This is the difference between paper and physical. This is what Stage 4 means for different groups of people. J.P. Morgan, governments, institutional investors. They're positioning for Stage 4 with physical metal, not paper. Physical. They're getting out of paper. They're getting out of the financial system representation of silver. They're getting into physical possession. And that should tell you something. That should tell you that the people who see Stage 4 coming are preparing accordingly. They're not waiting for prices to spike. They're not waiting for the shortage to become obvious. They're already positioned. They're already secured physical supply. And this positioning, this accumulation by the smart money, is one of the clearest signals that Stage 4 is coming sooner rather than later. So where does this leave you? Well, what do you do with this information? Here's what I know. The COMEX vault drain from 346 million ounces to 43 million ounces is real. It's documented. It's happening. The supply deficit is real. 5 consecutive years of production falling short of demand. 661 million ounces short cumulatively. The industrial demand is structural, policy mandated, can't be destroyed by price alone. The mining response is slow, 8 to 15 years minimum for new supply. The lease rates and backwardation signals are telling. They precede major moves. They signal acute shortage. And the positioning by J.P. Morgan, by governments, by institutional smart money is clear. Everyone with knowledge and capital is positioning for Stage 4. So Stage 4 is coming. The only question is what Stage 4 looks like. How violent is the repricing? How fast does it happen? How much higher does silver go? And the answer is, the math doesn't care about your opinion. The math is mechanical. Supply is 843 million ounces. Demand is 680 million ounces. The shortage is 163 million ounces annually. Above-ground inventories are being consumed. COMEX inventory is 18 days of consumption. The math says prices must rise until something gives. And historically, something gives violently. Not smoothly, violently. This is Stage 4. This is what comes next. If this opened your eyes to the pattern, if you now see the connection between COMEX inventory drain and silver shortage and coming prices, subscribe. Because what happens next in the silver market will determine who prepared and who didn't. The people who see the pattern, who understand the mechanics, who position before Stage 4 completes, they'll be on the right side of the move. Everyone else will be holding paper promises while smart money holds physical metal. And by the time the masses realize what's happening, it's already too late. The physical silver is already owned. The positioning is already complete. The Stage 4 move is already underway. So the real question is, are you positioned? Do you understand what's coming? Can you see the pattern? Because the pattern never fails. The pattern is mechanical. The pattern is mathematical. And the pattern says Stage 4 is here. The COMEX drain is real. The shortage is real. And the time to understand this, the time to position accordingly, is right now, before Stage 4 completes. The clock is ticking. The vaults are emptying. The moment of clarity is approaching. And very soon, everyone will see what we saw coming all along. Prepare accordingly.